thank you so much for joining us here at SuperReturn International. 5,000 people here, it's record-breaking numbers, perhaps coming together to try and navigate this very challenging macroeconomic environment. Tell me about that and what you're seeing in terms of where we're at.
Sure. What are we seeing? I think it's well publicized at this stage that it's a slower M&A environment. But I think, to use a beloved English expression, we're seeing some green shoots. I think we're seeing some growth in M&A in terms of size of deals, confidence in the market, and as a result, on the direct lending side of things, that's positive for my business. But also, I think where we've seen some interesting opportunities over the past couple of years is as part of our incumbencies. So, the scale players within the direct lending space will have very large portfolios. And time didn't stop over the last 24 months. So there's been a lot of incremental capital deployed into those companies.
So I was going to ask you really, how have things changed since the conversations a year ago at this conference, would you say? And you're talking there about green shoots and possibly potential for perhaps more speed in the market, more kind of potential and opportunity?
Yeah, if you compare it to 12 months ago, we had a closed syndicated market in kind of Q3 last year. That's reopened this year, which is a move to more normality. Big fan of that. I think we need fully functioning public and private markets for a healthy M&A and a more robust market environment more generally. What else are we seeing over the course of the last 12 months? Deal flow improved in Q4 as we went into the end of the year. If I was sitting here this time last year, I would have been talking about incumbencies, incrementals, very little M&A, poor quality M&A opportunities that were in the market at the time. That's improved greatly as well. I think the bid-ask spread between buyers and sellers is narrowing. Better companies are getting away. They're getting away for high multiples. And the private credit, the direct lending markets have remained open throughout. So, we're looking to capitalize on that certainty of delivery, of execution.
You said we're looking to capitalise. How will you go about doing that, and what's the best strategy, and what team do you need to be able to do that in this environment?
It's very relationship-led in Europe, in my view. So you need really good, solid, repeatable relationships with financial sponsors. We only do private equity-backed transactions. So guys that you get to know well, what they're looking for is certainty of execution. They're looking for someone who can bring something to the table in terms of diligence as well, an understanding of the sector, so it's not constantly an information flow in one direction. And from our perspective, we have 60% repeat borrowers. We have 98% repeat sponsors. So very strong stats in that space.
We're also seeing perhaps an uptick in the take-private interest as well in this environment. Is that something you're seeing, and do you think that's a trend that will continue?
Yeah, we have definitely seen it. We have financed a number of them over the past 24 months. It's definitely interesting. I think private equity are very good at hunting out value within the markets, and there's a number of very high quality software businesses, for example, that we've looked at and helped finance over the past 24 months. I think that continues to be a trend as we go forward in the next 12.
You talked there about hunting value. What levers are the best to pull in this sort of environment, and what do you think will come into play? People have talked about even perhaps Gen I having an impact because it will speed up processes and therefore perhaps improve liquidity.
Mm-hmm. I guess, Gen I is going to be very specific to business by business, sector by sector. So if we take software, for example, when we look at the effects of Gen I, we look at it from is the business going to be replaced by this technology? No, it's not. In that instance, okay, next question, how does it benefit the business? Well, actually, it really helps from a capitalized research and development cost base. So that will be reduced in terms of time. So it's actually can be quite beneficial to certain sectors. It's top of mind as we underwrite credits and look to build a portfolio going forward.
Just how would you say new market entrants are kind of reacting to this, and what impact is that having? Are you seeing that happening as well?
In terms of new market entrants?
Yeah.
I'm a big believer in scale, right? I think you need to be the guy that can speak for a very broad church of transactions, whether that is a smaller 10, 15, 20 million EBITDA business, firmly in the kind of lower mid-market space, but right up into the mid-market, upper mid-market space as well. Relationships are driven off of wanting to be able to call one person for the transaction. They don't want to have to do a decision tree to figure out which lender they want to speak to. once you get over that hump of getting the call and the transaction, it's a case of how much can you hold in a deal. And from our experience, people want that to be a continuous relationship that they're building with the lender, with the borrower being the company. So the ability to scale is very important. So I think for new entrants, that's tougher because the funds are smaller. Naturally, they'll have a lower hold size. So to some extent, they are really dependent on a lower mid-market flow.
Obviously, we've got big elections on the horizon, both in the UK and America. We've seen India's elections just happening. Half of the world are voting in democratic elections this year. What sort of effect does that have, and what do you expect to see in terms of interest rates in the markets that you're very active in?
Sure. So interest rates, it's a matter of, I think, when they get cut, not if. I think we're broadly expecting the ECB to do, the deed this week. So we'll see if that comes to the fore. But I think more generally, as we think about underwriting risk from Golub's perspective, what we are looking to do is make sure that we are underwriting all uncertainty, right? You can't tell what tomorrow looks like, whether it's Trump in the US, whether it's Starmer in the UK. Who knows? Well, we probably have a good idea, but who knows? You have to be able to underwrite all scenarios. And that's what we do at the firm. We are making sure that we are weatherproof, that the businesses can be resilient to, the shocks that we've experienced over the last 2 years. And I think if you go back to the middle of 22 and everything that was forecast to happen, I'm not sure anything actually landed, right? It's been the most bizarre 24 months for, we expect this to happen, didn't happen. So you have to have that flexibility in underwriting. Otherwise, you could be blindsided.
And arguably, this industry has to work a little bit harder in that environment than it has in the past.
I would argue our underwriting doesn't change from good markets to bad markets to uncertain markets. It's the same process we go through. We have to show to our committee why the business is resilient, why we like it, what the downside scenarios look like, what our second way out is, because, first and foremost, we're there to deliver a return for our investors, but you must get the money back to do that. So it's highly important that that's your first port of call.
Thank you so much for your insights. Always great to talk to you. Thanks so much.
Pleasure. Good to see you.